Okay, I'm really sorry. I'm sorry. Thanks, Monisha. Thank you. Thank you. Thank you so much.
Sure, sir.
I'm sorry for those who are joining in YouTube. In fact, YouTube link is not shared to, clients. It's only given to our students only. So I'm sorry for those children, and I'll be covering all these things. In fact, I have not talked much so far. I'm only starting now, so you're not missed much anyway, except the formal introduction and the opening. Anyway, thank you. So far, there has not been any specific main requirement how the books of account to be maintained, what is to be maintained, what are the books to be maintained, because all NGOs that are registered with income tax exempted under section 12AB right now, because 12WA is no more, under 12AB, and we need to get the accounts audited by a chartered accountant, okay, by us CAs, and we need to submit a report in form 10B. We are filing that. Organization that enjoy exemption of section 1023C, they submit report in form 10BB. Okay, we are filing that. So for that, we don't, issue certificate. We don't issue form 10B unless the books of accounts are maintained. So we certify that. But there is an express provision now, which is being introduced now in section 12A 1B, which is in fact it replaces the existing one. But it says is that where the income of the trust exceeds the maximum amount. Right now it is 2.5 lakhs. When your income exceeds 2.5 lakhs, the gross income, the income tax department will prescribe the books of account, okay, or other documents, and that are to be kept, okay, and in such form and manner, and also such place where it should be has to be kept. We do not know what they will do. They will come out with the rules when it comes. Okay, so at that time we will know. So it is expected. The rules they will give that. So it may be the cash book, ledger, vouchers, receipts, and also they will say head office or where you have branches. All this it is expected. The subsection 2 we already have that. It also speaks about furnishing of tax audit report from 10B within the time specified. Okay, this is effective from this next financial year, 22-23. So hopefully by this April, they will come out with the rules and specify the books to be maintained by us. Okay, right. The next one, the next change, very important change. What it says is that so far we are allowed to follow either cash basis of accounting or accrual basis of accounting. Under FCRA, Foreign Contribution Regulation Act, we are following only cash basis of accounting, or at least FCRA recognizes cash basis of accounting, the reporting. Because what is the amount you receive? What is the amount you utilize? Only that we report under FCRA. Income Tax Act, we have section 145, which primarily applies to the business community. Also, it says that profit and gains, income from profit and gains, profession or business, or income from other sources. Okay, PGBP, we call this. Okay, right? So from other sources, they need to follow either cash basis of accounting or accrual basis of accounting. What is this cash basis of accounting? As I explained to you in the beginning, cash basis of accounting is that what you receive account, what you pay you account. For example, we run a school. What we do is that whenever the children pay the fees, we account the fees as income. Supposing there are any arrears of fees, normally schools will account that arrears of fees as income, because then only it is easier for them to track and then follow up with the children. Okay, right? Donations, we don't do that. Whereas there are any other fixed income, for example, fixed deposit interest. Bank may not pay by 31st March, but we account that income, accrued interest, as income in our books of account. Main reason is that we want that to be tallied with our 26 A's. I'm sure you're all by now aware of what is 26 A's. Okay, we account that. But donations, generally, we account only on cash basis. What it says is that the proposed amendment, what it says is that section 11.7 explanation, from now onwards, from financial year 21-22, this year onwards, you will be allowed as application only the amount which you actually spend. For example, you are a school, I'm taking example school because most of the schools we follow accrual based on accounting. What we may do is that salary for that month, because it's due, we account it as payable, and the next month when we make payment, we set off against the payable entry, or rent for that matter, or any expenses payable. For example, you buy some notebooks, stationeries, which normally happens. Schools get credit, they get notebooks, textbooks, or other material. They account it as payable, and when they make payment, they account payment entry. But from this financial year onwards, NGOs, charitable organizations, which have exemption under section 11 to 13 or section 1023, can claim as application only when you spend that actually paid in that year. Okay, I mean, in fact, it very clearly categorically says that irrespective of the previous year in which the liability to pay such a was incurred. Okay, in this year, the liability to pay that amount is due. Right? You are liable to make payment. For example, you are constructing a building. Let me restrict the school. You are constructing a school building, and the contractor gives you a bill in the month of March. You do not have income, but you are accounting that as payable. Okay, right? It very categorically says that irrespective of the accounting method that you're following, even if you follow accrual basis of accounting, application will be allowed only when you make actual payment. This is a huge, huge change that all of us need to note down. Okay, right? The next one, there is a provision. What it says is that supposing we have claimed in earlier years as application. For example, expenses payable, we have accounted that, okay, right? And we claim that expenses as application in previous year. And this year, when you are making payment to the creditor, the supplier, that will not be allowed as application. I hope I'm making myself clear to you. So any payment towards the liability will not be allowed as application because you have already claimed the expenses as application in the year in which it has become due. Okay, right? I hope I'm making myself clear. But this brings challenges to Section 8 companies. Of late, Section 8 companies are becoming popular amongst NGOs, and we are registering Section 8 companies. Companies Act mandates that we follow accrual basis of accounting. The next, GST. GST, what it says is that when you are selling any product, you have to raise invoice. When you are rendering any service, within 30 days from the date of rendering service, you need to extra invoice. When you raise invoice, you must recognize that as an income. Again, when you buy some goods, when you buy somebody, the seller will account the GST on your bill, and that will be reflected in the GST portal. And to match that, you will naturally go in for accrual basis. So this is going to create problem for us. So we need to figure out how we are going to work on that. Okay, right? So how we are going to work on that. We need to figure out. So we are going to have trouble working with under GST and Section 8 companies. Not all NGOs are having GST, and not all NGOs are Section 8 companies. So other people, maybe schools, hospitals, you will have trouble from this financial year. So please remember to follow cash basis of accounting for expenses. Income, in fact, income tax law, it is possible to have accrual basis. Because when you follow, I mean, in schools, the fee not received, so you account that as an income. We have a specific section, section 11.2, explanation to that section. What it says that, supposing you have not received income in that year, because of that, your application is less. For example, in this year, your income is 100,000 rupees, 1 lakh rupees. Out of that 1 lakh rupee, fee receivable from your students is, let's say, 20,000 rupees, which means that you have actually received only 80,000 rupees. And you have applied this 80,000 rupees in this year. What the income tax law says, it says that we should apply 85% of our income. What is 85% of our income? 100,000 is our income, because we have included even the accrued income, fee receivable. And how much we should spend? We should spend 85 rupees. How much we have applied? We applied only 80 rupees. Why we have applied 80 rupees? Because we did not get 20 rupees. That is the fee receivable we not received. Such cases, income tax law says that you can use option under section 11.1. You have to file form 9A and claim that as a deemed application of that year. So income in certain areas, income tax law under section 11 recognizes accrual basis. Whereas what is proposed is that under the expenses side, payment side, no more accrual basis, which means that NGOs from now onwards will be following hybrid basis. So income will be accrual, expenses will be cash basis, payments will be cash basis. This is going to be challenged. So please work with your CAs. I mean, there are some of us other than my clients are here. Please work with your CAs how best you are doing in this. Okay, right. I just give few minutes for you to put on your questions in the chat box so that at the end I'll clarify your questions. Okay, please put on your questions in this, and then I'll move to the next area. Agency, we'll go to the question and answer a little later. I'm just giving a small break for them, a minute for them to type in the chat box the questions. Okay.
Yes, sir. Okay.
Agency, we'll go to the question and answer a little later. I'm just giving a small break for them, a minute for them to type in the chat box the questions. Okay. Is my screen visible now?
Yes, sir. You are visible, sir, although the PowerPoint presentation is not visible yet.
Yeah, I'll again.
Okay.
Okay, thank you. Okay, we'll move to the next area. Change in section 11.3. The period for utilization of amount set apart. I'll briefly explain the background and then I'll go forward. Income tax law gives us different exemptions to NGOs, okay, provided we are registered under section 12AB now. Okay, right? If you are a registered organization, you have different exemptions available. And one such exemption is that say amount set apart for specified purposes or amount accumulated for specified purposes. Okay, right. Amount accumulated for specified purposes. So amount accumulated for specified purposes. I'll explain this amount accumulated for specified purposes, and then I'll go further. Okay. See, what happens is that in case you're running an organization and you have a project which is a large one, and you're not able to raise enough resources for the particular project. For example, you want to construct, I've taken an education institution. So let me continue with the education institution. You have a school building project for which you need a lot of amount. Let's say you need 5 crore rupees. Raising 5 crore rupees in 1 year, it is not possible. So what you do is that you get donations from people and you earmark that amount for construction of school building, classrooms. So what we do is that every year we earmark out of the income a particular amount, and we call this a setting apart under section 11.2. And how do we do that? We convene in the board meeting, pass a resolution saying that we are earmarking so much amount. Let's say the total project is 5 crore. Year one, we say I'm earmarking 1 crore or 1.5 crores. Okay, pass a resolution. And also we invest that whatever amount, 1.5 crores that we are earmarking, we invest that in specified modes. Okay, we put that money in specified modes or let's say for our understanding, bank deposits. It can be savings deposit, current account deposit, or fixed deposit. To be on the safe side, let's say there is a fixed deposit, and we need to file form 10. But we need to be clear within which year, how long you need the money, within which period we want to complete that. And it is possible for us to set apart a maximum of 5 years. You cannot go beyond 5 years. So let us say we specify that in 5 years' time, I will spend this money. Okay, right? And what section 11.3 says is that if you don't spend that money in 5 years' time, okay, right? If you don't spend that money in 5 years' time, or the 6th year, the immediately following year, okay, or in the year immediately following the expiry thereof. So what it means, supposing you are earmarked for 5 years, and on the 6th year, the existing law says you can even use the amount in the 6th year and then complete the project. But what is this condition? The amount that you have earmarked should be available in 11.5 mode. What is it, 11.5 mode? In the previous subsection, it says that 3B. What is 11.5 mode? Bank deposits. I'm just giving it for easier one. It can be savings deposit, current account deposit, or it can be your fixed deposit, term deposit. It should be there. If it is not there, then it becomes taxable. So in case, let's say your earmark of 5 years, In case you don't spend it even by sixth year it becomes taxable. Okay, right? So you have 5 plus 1 under the existing provision. What is now proposed? The proposed one, it says that you earmark an amount, okay, right? And you say that it is to be spent for school building purposes. But you spent it for administrative block. Okay, classroom, instead of classroom, you spend it for administrative block. Or rather, I'll put it this way. Instead of classroom, what you've done is that you purchase computers for children. It is not for the purpose for which you earmark. Okay, right? Or the amount in 11.5 is not there. For example, you have put your earmark 5 crores, you have 4 crores in your bank account so far. When you say 4 crores under 11, section 11.2, out of that 4 crores, you have drawn, let's say, 3 crore and then gave it as a loan to another organization. You're not supposed to do that. I'm just giving an illustration. If you do that, then again, you're losing exemption. Or this is the amendment, this is may be introduced now. If you don't spend within that 5 years, the earmark for 5 years, you don't spend within that 5 years. There is no question of 6th year now. So in the 5th year itself, the amount becomes taxable. Okay. The next one, what it says is that even if you transfer that to another organization, okay, whether they have 12 WA or 12 AB or section 1023C exemption, even if you transfer, then it becomes taxable in the year in which the transfer takes place. So this is the 11.3 amendment, and takes place from next financial year. Okay, right? So this is what is 11.3, and I've already explained that to you, so I don't need to explain any further in that. Let me move to the next one because I don't think you'll have many questions. In case you have questions, you can put down the questions here in case you have any questions. Let me move on to the next one. Voluntary contributions to temples, mosques, churches, or other places notified under section 80G2B. Okay, right? Please note that this is not your regular donation to the churches. Okay. So those of us who are attending from church background, let us not have been thinking that no, budget 2022 is bringing some favorable clause. So this is not that one. What is corpus? Because this is going to talk about corpus. So this section, the amended section, is talking about corpus. Expression 3 and 3B to section 11.1. What is corpus donation? In fact, earlier I've showed you a slide where there is different exemptions available to us. One exemption available to us is corpus donation. Okay, right? In case we get corpus donation, that corpus donation is exempt. So what is corpus donation? Corpus donation is a donation or voluntary contribution with a specific direction that they shall form part of corpus of the trust. When the donor gives you a specification, it's a voluntary contribution made with specific direction. The donor has to give a specific direction. It cannot be inferred from the context. It has to be very specific. It has to be written. Okay, they should put it in writing. They should address it to you, to the organization. Say that I am giving you, I am contributing you so much amount that amount shall form part of corpus of the trust. That written declaration from the donor is essential for us to claim any donation as corpus donation. The moment when we get a corpus donation, that is not income, that is outside the purview. Even for calculating 85% of our income, we need not worry about this corpus because corpus stands for a different footing. So corpus donation or as a different category. But now a new main explanation is being introduced. New clause is being introduced in budget 2022. what it says is that the amount voluntary contribution received by a trust, okay, right, where there is a places of worship, okay, as I talked about, main temples, mosques, churches, okay, which are of importance. I'll tell you what it is under section 80G2, okay. Then, this is the purpose is they are receiving it for the purpose of renovation or repair of such temple or gurdwara or church or other places. Then the directors, the trustees or the board members may at their option, the organization at their option can treat that donation which is received for renovation or repair or the temple or other places of worship as corpus of the trust. I want to understand the distinction here with reference to the normal corpus. On the normal corpus, the direction, the letter should be from the donor. Whoever grants to the fund, they should give you as corpus. Whereas here, when it comes to places of worship, which is specifically meant for renovation or repair, the law says you have the option to treat that amount contribution as corpus of the main trust. Okay, there are some conditions. Okay, what are those conditions? The condition number one is that it should be used, it should be applied only for the purpose for which the contribution is received. What is the purpose? Renovation or repair of the temple. Okay, right? And you do not use this money for any other purpose or make donation to any other person. You raise as a temple because you are a place of historical importance. Government grants you, notifies you as an organization. But what you do is that after getting that, you transfer to somebody else. That is not possible. You cannot do that. Okay, right? And you should keep this corpus separately identifiable. Maybe you'll have to open a separate bank account, or you'll have to keep a separate fixed deposit for that. And you should keep that amount in deposit 11.5 mode. Okay, right? I mean, 11.5 constantly keeps coming. I'll share you. I mean, I don't have the slide with me right now. I'll share when the presentations are shared, the line 11.5 modes. So only when you start exercising all the conditions. But what is the essential condition is that the amount that you receive for repair or renovation of a place of worship, if you want to treat that as a corpus, you'll have to keep that in deposits. 11.5 modes. The deposit can be savings account, current account, or can deposit with a bank account. Okay, nationalized bank or scheduled bank, and use that money only for repair or renovation, and do not use this money to give contribution to any other person. You cannot use this money. Okay, and this corpus should be identifiable. Okay, right? So when you follow that, you are allowed for that. Supposing you don't do that, you fail in any of these conditions. For example, government grants you exemption as corpus, which means when they say it is corpus, it is outside the purview of your income at all. So, and you understand why they are giving it, because see, large places. Take for example, we have this St. Mary's Church or Santom Cathedral or some of those huge temples. Okay, right? The renovation may not be completed, or the repair work of the temple or the church or the place of worship will not get completed in 1 year. You raise large sum of amount of money, but not able to complete. Unfortunately, the organization, the trust may end up paying taxes. So that is why government brought in this particular, bringing in this section, saying that when you are getting money for repair or renovation of a place of worship, okay, I give you time for you to spend the money, not be in a hurry. Keep that as corpus, because when it's a corpus, we have n number of years to utilize that money. Keep that as corpus and you spend that. You get that money for renovation or repairs, but you don't need to do that this year. You may need that after some time. Keep it in corpus. When you want that money, take that and use it. So when you don't do that, for example, you say with this corpus and put that money in deposit. Tomorrow, you withdraw that money from the corpus. At that time, that becomes income. This is very similar to corpus, which I'm going to talk to you a little later about it. Okay, when you withdraw money from the bank account, then it becomes your voluntary contribution subject to section 11 to 13, subject to 1023C conditions. Or you use this money for any other purpose, then again it becomes income in that year for which you are receiving that. Or you take this money and then give as a donation, grant, or transfer to another organization. Okay, right? One of your institution needs money. For example, the church runs a school and you contribute to the school, then it becomes income. So you have a problem. Okay, right? And this is what I've explained to you. And what is this section 80G2B? Very clearly says that the central government by official gazette will notify this. Okay, right? And what is that? These are all places of historical or archaeological or artistic importance, or to be a place of public worship of renown. So if you qualify that, maybe if your church qualifies that, if you want for renovation or repairs, you can approach the central government for getting this approval. Okay, right? Because we're talking about corpus, I thought let me explain the changes that took place last year and previous year, 21 and 22. Sorry, 20 and 21. Okay, right? I already explained what is corpus. Corpus, till 2 years back, or till last year, corpus was when you get any income with a specific direction that it shall form part of corpus of the trust. Then it becomes corpus. Okay, but once when you get the amount as corpus, it was left to us. There was no condition that it should be kept in bank deposit section 11.5, or that it should spend only for the capital assets. There was no such condition. You can raise corpus donation and can still use that for running your organization, your recurring expenses. It was possible for you. Okay, you can raise corpus donation and not invest that. It was possible. So what government said is that in 21 Finance Act, what they said is that when you are raising corpus donation, you must put that money in deposits, 11.5 deposit. In simple terms, it should be in bank deposit. Bank deposit can be in the form of savings bank, current account, or term deposit, fixed deposit. It should be there. As long as it is there, it will be treated as corpus. Okay, the moment when you are withdrawing money from that account, it will become income of that year. Because as I've been explaining again and again, if it is a corpus, when it is outside your purview, what is section 11.1 says that our incomes, we need to apply 85% of our income to get 100% tax exemption. Supposing my income is 100, I must apply 85 rupees so that I get 100 rupees as tax exemption. It is up to us, up to me to apply 90%, 95%, or even 100% and claim the exemption. In case I don't apply 80%, the balance amount becomes taxable. Okay, so when you say it is a corpus, you don't need to go into its working, you know, you don't need to go into this working of 85%, whether I'm applying. So it simply goes out of that tax computation part of it. Now, the change what took place last year is that in case you get corpus donation from your donor, okay, right? And when you want to claim the benefit, you must keep that in bank deposit. The moment when you withdraw from the bank deposit, it loses its characteristics as corpus donation. It becomes your income in that year. Supposing you deposit the money back into the deposit bank account, you repay that. For example, you had a corpus fund, a corpus donation, and you created a corpus investment of 1 lakh rupees. For easier understanding, you have drawn 20,000 rupees, it becomes income, and you spend that. And you get another 20,000 rupees. What you do is that you deposit voluntary contribution, regular one, you deposit back this 20,000 rupees. This 20,000 rupees will become your corpus donation. So this was the change that was introduced in last year. Okay, right? And year before last, 2020, the change. What it says is that when you have a corpus donation, sorry, when you make donation to other organization, you are allowed to contribute to other organization. Okay, provided it is with a similar objective. Okay, right? Both should have the similar objective. Both should have 12 AB registration. Then when you are contributing, and when you are contributing, you contribute as corpus, then you will not be able to eligible to claim application of that amount. Okay, right? So this used to be a mechanism by some of our organization to avoid taxation. For example, in this year, I received a lot of income. Okay, right? I received a lot of income in my trust, and I am not able to apply the entire income. Let's say during COVID time, plenty of donors contributed to me, and I have large surplus with me. What I do is that I have another sister concern which also has received funds and then they applied it. I give contribution to that sister concern as corpus donation. When I give contribution to my sister concern as corpus donation, my sister concern will get corpus donation because I give a specific direction, letter to the effect saying that this is corpus. They get tax exemption because it is corpus donation, they don't need to pay. They don't have to worry about computing 85% of that corpus donation. I also used to get exemption application because this is transferred to the similar organization allowed as application under section 11 and section 1023C. Government said 2020 onwards, no more such tax planning, no more such way of doing things. If you are contributing as corpus donation to another organization, your contribution will not be eligible for application, which means that it will be subject to taxes. Okay, right. I'll give some break for you. Please, if there are any questions, you can put those questions in the chat box, and then I'll continue. I'll give 2 minutes break. Let the screen be there. Don't switch the screens. Okay, we'll continue. Am I audible? Just put a yes or no in the chat box. Oh, okay, right. Thank you. Right. The next set of amendments that are being proposed is cancellation of registration and section 12AB. In fact, the entire subsection 4 and 5 are being replaced with a new subsection. Before we get into this cancellation, let's first understand the registration. And of course, we all know that all of us have gone through this revalidation process now. And our next renewal comes 5 years from now onwards, or maybe 4.5 years from now onwards. So we have the next renewal coming up. And those of us who have gone for provisional registration will have to renew, go for regular registration within 6 months from the commencement of activities or within 3 years, whichever is earlier, you have to go through that. So at that time of regular registration or renewal, okay, right? What the section says, section 12AB1 main subsection in clause B says that the principal commissioner or commissioner on receipt of an application, he shall call for such document information to make sure that that the genuineness of the activity of the trust, okay, right? The trust is genuine and the activities of the trust are genuine. How do we say it is genuine? I mean, I've given a Supreme Court citation, Ananda Social and Educational Trust. It says that the commissioner should look into the objects of the trust, whether they are genuine or charitable, okay, right? And whether activities of the trust proposed are in line with the objects of the trust. So as long as it is there, then it is genuine. Then the next one, it talks about the conditions which you may look into that. Complaints of requirements under any other law. We'll talk about it a little more under any other law. And that are material for the purpose of achieving the object of the trust. Okay, right? So this is what it says that. So commissioner will be looking into that. And then if he is satisfied, he will grant registration. If he is not satisfied, he will refuse to grant registration. He will reject the application. So this is a registration process. So with this background, let's get into the cancellation process. Okay, right? This is a new one. I mean, this section is being introduced now. Okay, right? Here it talks about the registration or provisional registration of the institution. Okay, right? It is under section 12WA and also 1023C. Okay, right? Where it is granted, the principal commissioner can take the action for cancellation. So far, the law is that it's only the regular registration cancellation is possible. Now they are introducing even for the provisional registration. Earlier, the logic, at least to my understanding, was that anyway, once when they commence activities, within 6 months they will be going for regular registration. Commissioner will be going through that, and then he will has the opportunity to cancel the registration. But now what they're saying is that even provisional registration, supposing somebody within 6 months is not going because he has to get paid up 3 years, and he files the return also, and then he goes there. So tax department commissioner can invoke this particular subsection and then take action for cancellation. Then he can do that. There are 3 main instances when the commissioner can initiate cancellation. Number 1, when there is an occurrence of specified violation. I'll come back to what are those specified violations. Okay, when there is an occurrence of specified violations, commissioner can invoke the cancellation provision. Number 2, when commissioner, when there is also a principal commissioner, so one of them, when commissioner receives a reference from assessing officer, this is 143.3. 143.3 is connected with the assessment proceedings. All of us, I'm sure, have gone through this assessment. Our cases are taken up for scrutiny, and we are asked to submit all details. And then the income tax officer or whatever the assessing officer will go through, and then he'll ask clarification, And during that process, assessment process, the assessing officer has reason to believe that this society or this trust registration needs to be cancelled or warrants to be cancelled, he can refer that to the commissioner, the concerned commissioner or the principal commissioner. Or the case has been selected in accordance with the risk management strategy. So far, they have not notified what is the risk management strategy for NGOs under this provision, because this is only a new one. Maybe they will come out later, or they may not even say that. Okay, right? But of late, all of us are aware that government is collating a lot of information about us, whether you're individual, whether you're a charitable organization, they get so much information about us. And the good thing is that they are making all those information available to us in the portal. You can download your information in annual information statement. And because of that, now the government says that you can find updated returns. All of us know the income tax return and all of us know the revised return. Now, the government says that you can file updated return because of the information that the government collected about us with a PAN number, with the Aadhaar number, right now with PAN number. Okay. And that information which is available with the tax department is being shared to us. And you can compare the information with returns, whatever you have filed. And in case you have disclosed your offered income list, government says that you file an updated return with the taxes and additional payment of 25%. Okay, on the tax due. So government has mechanism for this risk management strategy, and under that the commissioner can choose our case for cancellation. Three main cases. One is that specified violation. We'll come to that specified violation. What is that? Or the reference can move from the assessing officer. Now it is faceless. The faceless main officer AO may send recommendation to the commissioner. On his recommendation, you can do that. Or risk management strategy. Okay, right? And what are those specified violations? We'll go to that and then we'll come back to that. Okay, right? Number one, when the income is derived from property in the trust wholly or partly for charitable or religious purposes, but it has been applied for other than the object of the trust or institution. Let's take an example because these are all classic examples we have. Okay, we registered our trust some 20 years back, and we have forgotten what is the purpose for our trust was registered. Sometimes, when we come to our CA for renewal, either FCRA renewal or for income tax renewal now, our CA may go through that. Otherwise, we never go through that. We presume that we have the object. So we go on doing things. And in fact, one such instance happened to us for one of our clients. When he goes through that, and he may refer with your trust deed or your society's memorandum, and he may question. All these years, what happened is that if you are applying for an object which is not as per your trust deed, the AO will only disallow that part of the income and then ask you to pay taxes on that. Now it says that if you apply the income for other than the object of the trust, then there is a reason for commissioner to invoke cancellation proceedings. Please mind you, a lot of us, a Christian organization, we have a tendency. We have registered our organization as charitable, a social organization, but we are carrying on Christian activities. Okay, I don't want to elaborate more on that. And please remember, all these years it was not that very severe. Now the proposal is that the commissioner can invoke cancellation proceedings and can say that this is a specified violation and invoke cancellation. Then the next one, I hope this is clear. The next one, the trust has income from profit and gains of business, which is not incidental to the attainment of its objectives. Can a trust be involved in business activity? It's a big question. It's $1 million question. Can a trust involve? In fact, section 11(4)(a) says that Income Tax Act says that yes, the trust can involve in business, provided the business activity is incidental to the attainment of the objects of the trust. Okay, I'll explain that to you. It should be incidental to the attainment of the objects of the business. For example, I run a technical institute, okay, where I teach carpentry, where I teach motor mechanic to my students, okay, where I teach electrical work to my students. What I do is that as part of the training, I also have a garage where I get vehicles and service them. I employ people, good mechanics in the garage for maintaining the vehicles. I also use the garage as an opportunity for my students to learn because they are learning theoretically. I use the main garage as an opportunity for my students to learn. I have a carpentry section in my school. My students are learning to make tables, chairs, furniture, interior works. I also have a small showroom where I have, these tables, chairs, and furniture manufactured by my students. What I do is that if I sell only out of the manufactured product by my students, I'll be running on a huge loss. To augment the income, I also employ some good people and I manufacture where my students also get practical training. And I have a workshop. So this are the incidental to the attainment of my objective. If I have activity, business activity other than this, then the commissioner can select my case for cancellation. There is also a possibility business itself comes as the trust property. I will not explain more on that, just a possibility. That is also possible. Okay, right? Next one, you have, you have that income from profit and gains of business. Okay, right? And mind you, this is incidental to attainment of your objective. Second condition is that you're not keeping separate books of account because section 11(4)(a) categorically says that if you have any business activity which is incidental to the objects of the organization, then you should keep separate books of account for the business activity. You should, because you'll be getting you'll be raising invoices, you'll be making payment for that activity, you should keep separate books of account. Okay, only then you're eligible for exemption under section 11(4)(a). When you violate any of these, your business activity is not incidental to the attainment of your objective, or you're not keeping books of account, then your case can be selected for cancellation. The next one, you are a trust. Okay, you're a trust, which is a religious trust. Okay, right? You're a religious trust, but the income from the religious trust is not applied for public religious purposes, but it is applied for private religious purposes. Not necessarily the entire income, even part of the income. Okay, right? It does not ensure the benefit of the public. I mean, because if you have been attending my sessions, both my physical or webinar, I've been explaining this with illustrations. Okay, take for example, I mean, you have a temple, right? Initially, when you form the temple, you said this is for the public. The entire village people can come and worship that. And when you're constructing, you get donations, enjoy tax benefit. Afterwards, you say that that particular temple belongs to my family. Others are not allowed inside. When you do that, then you lose tax benefit. Okay, right? So with this, I'll stop now, and we'll take break for a few minutes. I mean, a coffee or tea break because you've been listening to me for more than an hour now. For an hour now, let's take a break for a few minutes, and then we'll come back again. Okay, right? Over to Jetsi.
Thank you, sir. The session is going really well. So now it's 11:46, so we will be having a 15 minutes break till 12 p.m. So kindly make sure that you are present at least 2 to 3 minutes prior the resuming time. And in the meanwhile, you can post your questions in the chat box given. And also kindly make sure that you are logged in your registered name to avoid any confusion. Thank you. Welcome back, everyone. So we'll resume the session now. And all your questions are being noted down so that sir can answer them in a consolidated way in the end of the session. So keep posting your questions in the chat box so that we can note it down. Over to you, sir.
Thanks, Jency. Thank you. Thank you so much. I'll repeat again, whatever your questions are, please put it in the chat box. And we are collating those questions and then I try and answer. Okay, right. Let's continue with the topic on cancellation of registration. We talked about when cancellation can be invoked by commissioner. There are three instances where commissioner can invoke cancellation. Number one, when he notices specified violations. Okay, we are talking about the specific violations only now. When he notices specific violations, or when he gets a reference from assessing officer. Okay, right? At the time of assessment proceedings, assessing officer can always refer the case back to commissioner or when issue back to the commissioner for cancellation. Then under risk management strategy, our organization can be selected for cancellation. Okay, right? And we're talking about what are those specified violations. Number one, we talked about amount applying for an object which is not as per the organization objects. Okay, number one, if it is not as per the organization objective. Second one, when I have income from business, profit and gains of business, which is not incidental to the attainment of the objectives of the organization, or I have income from profits and gains of business, and I'm not keeping separate books of account, in which case commissioner can select my case for cancellation. Or I have applied the income, I have registered as a public charitable trust, but I have applied not necessarily the entire income, even part of the income, which is not made of for the public, which does not ensure the benefit of the public, then there is a case for cancellation of registration. Okay, then the next one. I mean, all these, the earlier one, what I talked about is there in section 13(1)(a). And the next one, what I'm going to talk about is section 13(1)(b). A trust established for charitable purpose. Please understand this is a trust which is established or registered for charitable purpose. But the benefit goes to a particular religious community. Okay, it's not necessarily the entire benefit. Even part of the income is for the benefit of a particular religious community. Then there is a risk of cancellation. So we'll have to be very careful. Okay, it is not that a charitable trust involved in religious activity. Many times, even the tax department mistook this particular section. But please understand, a charitable organization involved in charitable activity, but the beneficiaries are a particular religious community or a particular caste. Okay, right? So basically, when we get tax exemption, we say that there are not any discrimination on the basis of caste, community, religion, sex, etc. So in such case, our organization can be selected for cancellation of registration. The next one, our activities are not genuine. Okay, right? You have an activity which is not genuine, then it is a case for cancellation or not in accordance with the conditions subject to which our 12(a)(b) was granted. We'll talk about those conditions because some of those conditions are going to be difficult for us to comply with, but we should be knowing that we should follow that. Okay, right? We are an organization, we are a 12(a)(b) registered organization, and we have got registration in 10(a)(c), Form 10(a)(c), but we are carrying out activity not according to the conditions to which we are registered. So when we are registered, we are granted certain conditions. Let's go through those conditions. Okay, right? There are a number of conditions specified here. I've taken only the important one or the relevant one. Other ones I'm skipping that because we will be normally complying with those conditions. The first condition, I'm sorry. The first condition is that when you want to amend, when there is a move to amend or alter the objects or even rules and regulations of the applicant, prior approval of the Commissioner of Income Tax shall be sought along with the draft amendment deed, and no amendment shall be effected unless approval is accorded. All these years, we were going only for amendment when there is a change in the object clause. There again, when it comes to trust deed, I mean, we have been advising not to go for that. Okay, but now what it says is that even for the rules and regulations, which means that even the trustees, board members, when you want to amend the clause, okay, right? Then we need prior approval of the commissioner, which is very, very important. So what we should do, we should submit, a draft amendment deed or supplementary deed or the resolution that we want to pass in case of the society with the commissioner, get his approval, and then only we need to proceed. Let's look into what is section 12A1AC5. I mean, it was introduced in 2020. What it says is that whenever there is any change in the objects which do not conform to the conditions of registration. Okay, right? See, because the reason why government has introduced is that you have an organization and we have taken registration exemption based on the objects. Normally, exemptions are granted based on the objects of the organization. Provisional registration. Only later on, looking into the activities, the mayor commissioner confirms the registration. But when you are carrying out any modification to the objects after getting the approval, then to defeat the purpose of exemption. So what government says is that if you are modifying the objects, okay, right, within 30 days from the date of that adoption of modification, you should file for fresh registration. Okay, right, you should file for fresh registration. This is the Act, section 12A1 subsection 1 AC5, okay, right? But what the registration certificate says is that forget about what is given in the law. Whenever you want to amend, come to me for prior approval. This, in fact, to me is a good one because tomorrow, after you amend and then go to the commissioner, and the commissioner says, no, 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 this is not as per the object, I will not grant you approval, I will cancel your registration. Whereas here, when you want to make any changes into the objects or in any of the rules and regulations, okay, right? You go to the commissioner first and tell him that, see, sir, this is what I want to do that. Please give me your approval as per the registration certificate. Once when he gives that, then based on which you can go ahead and then later on also you can file application saying that this is what I've done, these are the approval I've taken. So you are much safer. Then the next one, which we are all aware and all of us have that in our trust deed. Of course, society we will not have that. Trust deed we have that. See, what it says that in the event of dissolution, the surplus as such shall be given to an organization with similar objects. And no part of it, please note that no part of it shall go directly or indirectly to anyone specified in section 13.3. We'll shortly see who are those section 13.3 people. So you cannot, at the time of dissolution, any part give to any one of the specified persons. The next one, we'll go to the conditions there. Here it's also very similar to what we talked about it. Okay, right? When you're converting into another form or merging with any other entity, this is under section 115 TD. Okay, right? Fresh registration, fresh application, it should be fine. This is already given in section the accredited income section 115 TD. We'll be looking at that also. So when you're merging with another society, okay, it is possible. Or when you're being taken over by another trust, then you should file for fresh registration. Okay, right? Otherwise, accredited income provisions will kick in. And you should maintain books regularly, properly, regularly, and get the accounts audited. Okay, right? And please note here, most important thing. What it says is that for, let me take the highlighter, please. Separate accounts for each activity as specified in your trust deed. You should keep books. Okay, right? We do not know what they mean. It will be better that you create ledger heads for each activity. I'm sure we have that as it is. Okay, for each activity, we have separate heads of account so that our activities are identified. And please note that this is to be as per the trust deed or memorandum of association. And also, we should submit that to the AO now. And in fact, we have all done that along with our tax returns. When Form 10B, we have filed that, okay, may not necessarily in your Form ITR 7, but in 10B, we have filed this accounts where we have given activities. Not only that, we also need to give public notice. Okay, right? Let me erase all these things. Okay. We also need to give public notice of activities, okay, carried out by the main trust, so that people are aware of what activities are going on. Okay, it should be available in the registered office or at the designated office of the organization. So we need to possibly publish our activity report and also accounts. Okay, right? So that our beneficiaries are aware of what is happening. Okay, that should be available in our registered office or designated office for that particular purpose. Okay, right? Next one, very important one. What it says is that, I'm sorry, because of the color background, I see this highlighter, I'll take this. What it says is that I should not shift my registered office from, from a place to another place where the jurisdictional commissioner is changing. For example, I think Tamil Nadu, we have two jurisdictional commissioners, one in Coimbatore, one in Chennai. Okay, right? So if I'm shifting my registered office from Chennai to, let's say, to Salem, which comes under the jurisdiction of the Coimbatore Commissioner, and I can do that only with the approval of the Chennai, possibly with the Coimbatore also with intimation to the Coimbatore Commissioner. So I cannot so moto shift. Earlier it was possible. In fact, we have done that. We have shifted the office from Madurai to Chennai. We have shifted office from Chennai to Bangalore. Now it is not possible. Now, if you want to shift your registered office from one jurisdictional commissioner to another jurisdictional commissioner, we should take prior approval from the concerned jurisdictional commissioner. Okay, right? The next one, the most important one. No asset can be transferred without the knowledge of the jurisdictional commissioner of the income tax. What is the asset? They have not defined. Kindly keep yourself on mute, please. Okay. What are the assets? It is not defined. All these years, what we were doing is that we were looking at the fixed assets. when I want to transfer any fixed assets, we were doing the due diligence. Now, what it says that no asset, which can mean even your laptop, it can mean even your vehicles. Okay, when you want to transfer any asset, you need to inform the Commissioner of Income Tax. There is no need of prior permission, at least as per the conditions given here. Sometimes the commissioner may say that, yes, I need to give permission also. It may come with reference to the immovable property, but as it stands, the certificate condition specified in the certificate also does not specify any condition that you should get approval. Unlike for the amendment of the trust deed or the memorandum, okay, or shifting of registered office, where it very specifically says you should get prior approval. But when you are transferring asset, they are using the word transfer, which means that even transfer to a sister organization, transfer to another society, not necessarily sale. Even sale is also transfer. So when you are selling or transferring to another organization, you should intimate the jurisdictional commissioner. Okay, right? So they made it very clear to anyone, including any trust. Okay, right? Trust for a non-profit company. The next one, this is again going to be challenged now. When you're getting any public money, right? What it says is that all this public money, all your donations, all your income, okay, right? They are not talking about voluntary contribution. They are using public money. So when you collect fees, when you collect can be for school, when you collect for fees for hospital or any activity or voluntary contribution, including corpus, that necessarily has to be routed through a bank account. Not necessarily only one bank account, it can be multiple bank account. And those numbers need to be communicated to the jurisdictional officer. Okay, right? That needs to be communicated to the office of the jurisdictional commissioner. We need to intimate the Commissioner of Income Tax Exemption Office of the Commissioner of Income Tax Exemption that this is my bank account. We are intimating to your audited report, but now onwards, it may be necessary that we send a communication to the Commissioner of Income Tax. Send a letter saying that these are the accounts through which we'll be operating our trust accounts, our charity accounts, our religious organization accounts. We have to intimate that. And please note that cash transactions will not be acceptable now. You receive in cash, you spend in cash will not be acceptable from now onwards. You have to be careful with that. Okay. We go to the next one because we just finished the conditions for specified in the uh, application, granted when you are registered conditions. The next one, because we are talking about various conditions, specified violations, then commissioner can take our case for cancellation. Okay, right? First, we talked about condition where it is not applied as per the objects of the organization. Then it can be chosen for cancellation. When my activity is not genuine, it can be taken for cancellation or not in accordance with the conditions subject to which my 12AC was 12AB was granted. My registration for exemption, either under section 1023C or section 12AB was granted. Okay, the next one. The organization has not complied with the requirement of any other law. Okay, right? This is referring to when subsection 12AB 1 and various clauses. What is that subsection means is that it says that complaints of any other law for the time being enforced or that are material for the purpose of achieving the objects of the trust. And it talks about any other law, compliance requirements of any other law. Okay, for the time being, that are material for the purpose of achieving the object. Mind you, you may not be aware of the laws, but the income tax department, thanks to the new faceless assessment, they know much better about the various law that you are required to comply with. We have been talking about the income tax law. Some of us get funds from abroad, so we need to be aware of the various complaints in the CRA. We need to be complying with the GST laws where it is required. We need to be compliant with the labor laws. For example, PF. PS is applicable to us if there are more than 20 employees to us. ESI. There are various other provisions, maternity leave. There are various other provisions, labor laws. We are not expert in that. You are expected to know that. There are sector specific requirements. For example, if you are a school, you may be required to follow Right to Education Law Act. If you are running a home, you may be, children home. You may have to follow Juvenile Justice Act, okay, JJ Act, popularly called. Or there are various laws that are there, and you're expected to comply with that. And if you're not complying with any of these laws, including the formative laws, either a society law, there is no specific law for trust, but Companies Act, if you're registered as a company, you have to follow that. If you violate any one of these laws, Commissioner can say that it is a fit case for cancellation. Okay, right? If you're running a hospital, you may have to have an incinerator for the bio waste. You may be a small hospital and you may not have that. That can be the reason for selecting a case for cancellation. I do not know. Hopefully, the commissioners will be reasonable. Okay, right? Looking into the volume, looking into the activity, and they look at that. But please mind you, they will not be looking at labor laws. They will expect you to comply with the labor laws. Please follow that. In fact, we have been telling all our clients to go in for PF registration, and I need to appreciate many of you have started going for PF registration now. Yes, you're going through difficulties. I appreciate you're boldly facing that, trying to sort that out, and then getting this covered under PF law. Okay, and many of you are going under the ESA registration also. I really appreciate that. Please check what are the other laws that are made specific to you, and you need to comply that. Okay, right? Ignorance of law cannot be an excuse anymore. Ignorance of law cannot be an excuse anymore. In fact, in the chartered accountants, we have a group. Recently, one of our friends posted the group. There are about 28,000 instances under which a person can be imprisoned. This is for the business community. Similarly, for charitable organization also, there are so many laws that we are required to comply in India. Please update yourself. If there is some possibility, if you're a larger organization, please have a compliance officer, and especially if you are a company registered under Section 8, making sure that you are following, you are complying with the various laws. You are not found wanting in complying with that. That will warrant not only under the specific act, but also under the income tax law cancellation. So please look into all these things. There is a time limit given now. It cannot be pending with the commissioner endlessly. If there is a reference, if there are cases, we talked about it. Commissioner need to pass within a period of 6 months. Okay, right? The cancellation order. Okay, right? This 6 months starts from the end of the quarter. Okay, in which first notice is that. Okay, right? Whether the reference to the commissioner comes from the AO or the specific violations, or you are carrying out activity which is not as per the trust deed, or your activities are not genuine, or you're not complying with the law that is required or expected of you to comply, for carrying out the activities of your organization. The moment when it comes to his notice from end of the quarter in which he gets notice, 6 month period. So maximum he may have about 9 months time for him to complete the cancellation process. So I've come to a very important, I've covered an important area. If there are any queries, please put it down. And please note that if your organization is cancelled, okay, there is a possibility that you could be taxed at the maximum marginal rate at 30%. Okay, right? Under section 164, you could be taxed at 30%, and you will not be eligible for section 11 in the subsequent years also. Okay, so you'll have to be careful about that. I'm going to talk about one more provisions, special category of taxation, but that will not be available to you moment when your 12AB is cancelled. So you have to be very careful complying with the law of the income tax law. Not only that, the other laws under which you are registered. Next comes the tax on accredited income. When your registration is cancelled, there is the question of tax on accredited income or exit tax as is being called now. One of that will be applicable to you. So please note that you will be following that. So if you have any queries on whatever I talked about, please put it in the chat box so that our team will collate that. I'll give you about 2 to 3 minutes so that you can note it down, and then we can proceed further. Okay, I'll start now. Whatever you have put in the chat box, and the students who are watching in YouTube, in case you want to have your queries clarified, you can put in the chat box in YouTube also if you are using a laptop or mobile. And one of us will collate that, or you can call our office and then WhatsApp or put it in a group so that we'll try to answer that questions also. Students who are watching in YouTube. Okay, right. Next, we go to tax on accredited income. A lot of amendments proposed in section 115 TD to TF, essential to include organizations registered as section 1023C. So right now, this tax on accredited income or exit tax is not applicable to organizations registered in section 1023C. So when they violate, when their registration is cancelled, they escape. Okay, right? So I'm going to talk about some more conditions. And they were not liable under that. But now under 1023C, amendments proposed, they are also covered under this tax on accredited income or exit tax. Okay, right? There are 3 instances under which this tax on accredited income can kick in. First one is that you are not eligible for grant of registration, either under section 12AB or under section 1023C. Okay, we'll learn little more about this sub-clauses little later. Or second condition is that, case is that, when you are merging with another entity, okay, right? Which is trust or institution, and objects which are similar, and are registered either 12 WAB or right now 12 WA is also possible because of the extended period up to March. But I'm using only 12 AB because 12 AB is the one which is now onwards. Order 1023C, merging with any other entity, or at the time of dissolution, I already talked about it as a condition. Okay, you are not transferring the asset to any other organization with similar objective. Okay, within a period of 12 months. Okay, 12 months from the end of the month of dissolution. Okay, right? There is still money available, then tax on accredited income will kick in. So, what are those conditions that are not eligible for registration or this benefit where tax on accredited income can kick in? The first one, the one is that your registration on 12 WA or 12 AB is cancelled, or 1023C is cancelled, or you have modified the objects. Okay, right? And that modification does not conform to the registration, either in 12AB or a 1023C. And you're not applied for fresh registration. Or you apply for fresh registration, that you apply for fresh registration and your application is rejected. I'm sorry, I'll just wait for a minute. Let them complete the prayer. Okay, your registration under 12 AB or 12 WA or 1023 is cancelled, or your okay, I'll just continue. I mean, even if that just bear with me. Your registration is cancelled, or you have modified your objects and you have not applied for fresh registration, or you applied for fresh registration but your application is rejected. Fresh registration is denied to you. Okay, then your a case for accredited income. Okay, there are three. First one is that your 12A is cancelled. Sorry, 12AB or 12WA or 1023C is cancelled, or you modified your objects and you're not applied for fresh registration. You modified an object, you applied for fresh registration, but your registration is refused, or you merge with other entity. Okay, right? And which is not, I mean, even if it is a 12WA and you're not applied for fresh registration, or upon dissolution, okay, right? I mean, we merge with another entity which does not have this tax exemption. I'm sorry, either 12AB or 1023C or 12WA, or upon dissolution, within 12 months from the end of the month when the dissolution took place, cannot transfer the assets to another NGO, other 12WA or 12AB or 1023C organization, then tax on accrued income will kick in. And what is the tax on accrued income? It is the here it is. It is the aggregate fair market value of the total assets less the liability of the trust. Okay, so aggregate fair market value of the total asset less the minus the total liability of the trust, and that income will be taxed at 30%, maximum marginal rate of 30%. Okay, if the rate changes to 35%, that will be the rate. Okay, so it will be taxed at that. And in fact, here there are certain exceptions to that. There are certain exceptions to this fair market value of the total assets. The exceptions are like you have created assets before you took exemption under section 12WA or 12A or 1023C. Okay, right? Or you got assets when you did not have exemption. So those assets will be excluded. And on the rest of the assets, fair market value, you will be asked to pay taxes at the maximum marginal rate. So with this, I'm coming to the end of cancellation process. If there are any questions, you can put in the chat box. I will continue with my presentation. The next one is a beneficial one, which is helpful to us, benefit to specified persons. Okay, right? I'll go to that. In fact, section as it stands now, as the law stands right now, I'm not talking about the amendments being proposed. What it says is that section 11 shall not apply, exemption under section 11 shall not apply due to the operations of 13.1. What is the 13.1? Public religious trust not functioning for public. Okay, I've already explained for the with reference to cancellation. Then you're not eligible for tax exemption. Then second one, public charitable trust. Income applied for a particular religious community or for a caste. Okay, then section 13.1b. 13.1c, income applied directly or indirectly for this one. Income applied directly or indirectly for the benefit of specified person. The third one, if investment in modes other than section 11.5. I already explained these two earlier. Let me explain what it is. They're using the word benefit, okay, right? Directly or indirectly for the benefit of specific person. Section 13.2 elaborates what are those benefits. We don't have much time to go through in detail about the various benefits that are listed. What essentially it means is that if the trustee or if the specified person get any benefit which is not due to them. Okay, I am a trustee and I am also employed in the trust as a principal of the school or as the administrator of the trust. And if I'm paying remuneration for the services rendered, then that is not a benefit because this is for the services rendered. I'm a trustee, I'm an accountant by my profession, or I have qualification as an accountant. I passed income and I'm employed as the accounts officer or I'm employed as the finance director and for which I'm paid salary. I'm a trustee, but I'm paid salary because I'm also an educationally qualified person, then that will not be a benefit. So section 13.1c is that if I am getting any benefit, either directly or indirectly, from the trust, then that will be kicking in. Let me first finish 13.1 and I'll go to the 13.1d. What it says is that the change that is being proposed in that. What is the existing section? It says that if there is any benefit to me, either direct or indirect under section 13.1c to the specified person, then I am not eligible. The trust is not eligible for any tax benefit under income tax. So section 11 will not be operational. Section 1023 will not be operational. In other words, the entire income of the trust will suffer taxes. And the tax department invariably takes a stand saying that if section 13(1)(c) is attracted, if there is any benefit to my trustees, in fact, we are fighting cases for a couple of our clients. I mean, what they say is that the entire income is subject to tax and the tax rate shall be at the maximum marginal rate. There are a couple of good decisions at Supreme Court. One is the case of Father Muller, another one is Working Women's Hostel, Working Women Hostels from Chennai High Court, and it is at the Supreme Court. Both have said that it is possible, restrict the disallowance only to the, benefit which they have enjoyed. But tax department is not accepting to that. In fact, there is also a circular from the income tax department restricting the disallowance only to the benefit portion. But now they are bringing a change in section itself. Okay, what it says is that it will be only that part of the income which is applied to the benefit of the specified person that will suffer taxes, not the entire income. I hope I'm making myself clear. I have not put this section per se because that is a little confusing. I have given the abridged version of that. So what it says is that only such part of the income that ensures the benefit of that specific person directly or indirectly, that will not qualify for exemption. That will suffer taxes. We'll see that little later under what section, how it will be taxed. Okay, I hope I am making myself clear to you. Okay. Who are those specified persons? The list is long. I will go through that. The first one is the author of the trust or the founder of the institution. Because I am the author, I am the founder of the institution, one of the founders, I cannot get any benefit. I am the author of the trust. I am 65 now. I have retired now. Because I am the founder, the trust pays me regularly some amount. No, it is not possible. If I've served and the trust has a policy of paying pension to everybody who served, and under that policy, I get some remuneration, some pension along with others, then it is acceptable. If I am made exception, then it will be treated as benefit. I don't have time to go through in detail about the benefits. Maybe another time when we do another training, then we'll look into that. Okay. Another one, a person who has made substantial contribution to the trust or institution. What is a substantial contribution? A contribution in excess of 50,000 rupees. What is the idea behind that? Just because I have given 50,000 rupees or more than 50,000 rupees, I should not expect anything in return from the trust. I have not invested in the trust to expect any return. This is not a bank. I put fixed 50,000 rupees and fixed deposit, and I should get return interest from that. This is not a business where I've invested 50,000 rupees that I should get dividend from that. When you give donation, that's it, forget it. Don't expect anything in return. The next, any trustee or the manager, whatever name you call, okay, right? Trustee or manager of the trust or the institution, or any relative of the main author, okay, or any concern where any of these above or have substantial interest. For example, it's a proprietary concern, it is obvious. It's a partnership concern or a company, substantial interest is only 20%. Where the partner, where the trustee holds 20% share in the partner, or LLP where he has an interest of 20%, a company where my trustee holds 20% share, then you do any business with those, business entity, organization, it should be at arm's length. It cannot be less than the arm's length market price. If it is less than the market price, then this section 13(1)(c), 13(1)(d) will be attracted. 13(1)(d) I'll explain it later. Who are those relatives? Okay. I mean, in fact, there's a big list. I put it in the form of a chart so that you can understand it easier. You're an individual, your wife, both your parents and grandparents, both are there. And your brother, not only your wife's brother or sister and their spouse, brother's wife or sister's husband, and their grandchildren, sorry, children and grandchildren. You have children, their grandchildren, and their spouse. So you can see the chart. Tax department is trying to cover a whole gambit of people under the specified persons, under relatives. If they do business, okay, right? And the interest, I mean, if they are proprietors straight away, I mean, it has to be at the arm's length. If they are partners or anyway connected, where their interest is only 20%, then you have to be careful while doing business with them. And this will be a case even for cancellation. Sorry, not for cancellation. I'm sorry, not for cancellation. Cancellation is removed now. This will be a case for special treatment law. Okay, right? Section 13(1)(d). What is section 13(1)(d)? Earlier, section 13(1)(d) said that if you are investing any investment in other than 11(5) or where any of these persons or your partners, say trustees, or having business interest, okay, any concern where your trustees have substantial interest, okay. Sorry. Okay, where you invest in any of these things or in 11(5), other than 11(5), section 13(1)(d) will kick in. When that happens, the violation, the newly introduced section 271(a) says that, WAE, I think it says that, whatever is the violation, the aggregate amount of that violation will be taxed an equal amount, and the trustees will have to pay that as a penalty. Okay, right? Am I making myself clear? See, whenever there is a violation under section 13(1)(c) or section 1023(c), okay, the assessing officer may direct such person, whoever is violating, the trustee, to pay by way of penalty an aggregate amount of income applied directly or indirectly by such person. First year it will be 100%, subsequent years it will be 200%. Supposing, AO says that the trustee has got benefited, and the value of benefit he says is 10 lakh rupees. Earlier, the trustee was not at all affected. The trust was affected. Trust income was not eligible for tax exemption, and the gross income was liable for taxation. So we have a main case which we are fighting before the main Commissioner of Income Tax, where the violation, according to the AO, is only 2.5 lakhs, but the tax levied was more than 40 lakh rupees, 50 lakh rupees nearly. Okay, right? For 2.5 lakhs, it was levied through 50 lakhs. Now, the proposed one, what it says is that after the insertion of this one, this will be taking place once when the finance bill is approved, the budget is approved, notified. The violation is 2.5 lakhs, the trustee will have to pay a penalty of 2.5 lakhs. If he's continuing this practice, subsequent year you pay 200%. Okay, right? I hope this is clear to you. And similarly, in case of 13(1)(b), the same thing. Okay, 13(1)(b) also the same. The violated amount will have to be paid. Okay, right? 13(1)(b) also equal amount 100% and 200% in case of continuing violation. They are also inserting one more new section, section 115 BBI. Okay, let me have that. I'm sorry, I'm doing a webinar of a long gap. Talking continuously for a long period tires me out. That is why I'm sipping a cup of coffee. Thank you, our team, for making this available to me. And thanks for patiently listening to me. This is a new section which is being introduced now. What it says is that this is in case of an assessee which are having exemption under section 12AB or 1023C, okay, and they have income, specified income. Okay, let's see what is those specified income. The income tax shall be payable, okay, at the rate of 30% on the, specified income, okay, right? 30% on the specified income. We'll see what is the specified income. And no MMR for here, okay, right? And it also says that no other deduction will be available on any expenditure or no setup of losses will be allowed under this. Okay, right? I'm making myself clear to you. So whenever, on a specified income, when we come across, the tax will be at 30%, okay, and no other deduction will be available on any expenditure, and you cannot have any setup of losses. What are those specified income? The first one is that income accumulated in excess of 15%, or which is not allowed under any other specific provisions of this act. We will see this little elaborately. Okay, right? Next one. This is section 11.3 or 1023C explanation, the third proviso. Okay, right? In simple terms, I explained to you about the amount being set apart for specified purposes for a period up to 5 years. In the 6th year now, you are not applied there. Now the change scenario or the proposed scenario, in the 5th year, you are applying that. Then it becomes an income under section 11.3. Such income under 11.3, what is not applied? Let's say your earmark 5 crore rupees. 5 crore rupees for construction of school building, and you applied only 4 crore rupees. You could not apply 1 crore rupee. That 1 crore will be specified income and it will be subject to tax at 30%. And from that, no other deduction will be allowed for you, including losses. Okay, right? The next one, section 13(1)(c). We talked about it right now. The specific violation. What is that violation? You have benefited your trustee. Or section 13(1)(d), where you have invested in concerns where your trustees have substantial interest, or you're invested in places which is not exempt under section 11.5. 11.5 in simple terms, it is scheduled banks or government companies, public sector companies. Okay, right? Public sector companies is where government of India or state government owns 51% share or more. If you are investing in private companies for better interest, earlier you were losing exemption. Even if you have invested 10,000 rupees, you were losing exemption. From now onwards, when this finance act, sorry, bill becomes the act, the budget becomes an act, only that portion of violation, as I told you, 2.5 lakhs in my client's case, only 2.5 lakhs will be the amount which will be subject to tax, and that will be taxed at 30%. Okay, right? The next one, any income which is not excluded under section 11(1)(c). What is this 11(1)(c)? Section 11 categorically speaks about income applied within India. And 11(1)(c) subclause C says that it should be applied within India. When you apply any income outside India, that particular amount that you apply outside India will be subject to tax at 30% now. I hope these three are clear. Okay, these 3 or 4 are clear. Number one, when you are earmarking for a specified purpose and you're not able to apply the entire income, you apply only part of the income, the rest of the income, or you earmark for a particular purpose, but you have not kept it in deposit. You have transferred that money to another trust, another organization. You are violating that 11(2) conditions, because of which it becomes income under section 11(3). Or you benefited specified person. That's benefit alone, not the entire income. That benefit alone. Okay. That benefit alone, I'm sorry. I'm sorry. That benefit alone. The next one is you have invested in other than 11(5), or where your trustees or relatives of trustees or managers hold substantial interest, or where you have applied income outside India. Please note this is only coming under section 11 exempted category. Section 1023C, even now it is possible for you to have application outside India. But anyway, don't do that. I'll just cover that little later. Okay, right? So this category of cases, your income, this specified income, will be liable for tax at 30%. So whenever there is any violation of section 13(1)(c), the trustees will be paying taxes equal amount as penalty. For the first year and the subsequent year, the violation will be taxed at 200%. Okay, right? I'll give you a few minutes for you to write down your questions, put down your questions, so that I will go under the next category. Okay, see this 115 BBI where 30% income, we have, I have not covered this one. It says that income accumulated or set apart in excess of 15%. Section 11, what it says is that, in fact, even section 1023C also says that it expects us to apply 85% of our income. Okay, apply 85% of income. So income applied for charitable or religious purposes is exempt, and you can accumulate up to 15%. Section 11.1, explanation 2 to 11.1 says that in case the income is not received during that year, because of that, you have a shortfall. Already gave an explanation, or for any other reason. For example, you receive a specific project grant which spills over more than 1 year next year, or you receive towards the fag end of the financial year, because the donors may project period differs from our financial year. Let's say you received grant in the month of January, February, March, and the project period is calendar year, January to December, and are able to complete within that particular year. Or accumulation of income, we talked about it. Or corpus donation, we already talked about it. Capital gain, I'm not going to spend time because I'm not have time for that. So when you have, when you're not able to use any of these exemptions and you still have surplus income, okay, right? Amount available, excess of 15% or not allowed in any other specific provision, and you still have some surplus income, what we have been doing all these years is that we were going under AOP trust, saying that we are category under the Association of Trust, and in the Finance Bill, Finance Act every year, we are categorized along with individuals so that we have the privilege of going under the slabs. First 2.5 lakhs, no taxes. Up to 5 lakhs, we go under, 10% taxes. Means of, 5%, yeah, 10%. Then 5 to 10 lakhs, 20%. Beyond 20%, now we were going under that. So what happens is that we were claiming application under section 11.1. 15% we were enjoying, and we were continuing to enjoy even this 2.5 lakhs also. From now onwards, it appears that if you are exhausting, 11.1, 15% and all these exemptions, okay, all these exemptions, whatever we are talking about here, and still you run the surplus, that surplus will be subject to 30% tax under section 151 BBI. So you'll have to be careful about that. So from next year onwards, you possibly may not be eligible. In fact, this is applicable for this financial year onwards. So you are possibly not eligible for these 2.5 lakhs. Okay, right? Kindly keep yourself on mute, sir, please. Next one is that, thank you so much. Next one is that section 13.10 speaks about tax computation in specified cases. What are those specified cases where, it is this new taxing provision comes into existence? Number one, 12A1 provides that will not be available, tax exemption will not be available if the institution does not file the tax audit report form 10B in time. In fact, a lot of NGOs receive notices from the CPC because they filed the tax audit report, and also they returned little late last year. Because of COVID and restrictions, we could not file. Many NGOs received that. That one, can take shelter now under the new provision. Okay, where you have not filed the tax audit report, or you could not file the income tax returns in time. Or the newly inserted provision, you have not kept the books of account as per the provisions that's going to be implemented now onwards. You're not keeping books of account. Or under section 215, you're violating. What is that 215? 215 is the charitable purpose includes relief of poor, education, yoga, medical relief, preservation, and employment. It goes on. See, 215, there is a provision. What it says is that if you have activity in any other category, the first six you have, business activity, there is no issue at all. For example, your education for which you are collecting fees, your yoga, you are collecting fees, your medical relief, your hospital, you are collecting fees. There is no issue at all. But your category under any other object of public utility and you collect fees in that, you are an activity, advancement of any other object of general public utility, and you collect fees, and the fee can be, cess or fee or any name you call it, okay, right? And it involves carrying out any activity in the nature of trade, business, or commerce, or even rendering any service in relation to trade, business, or commerce, and which involves collection of fee or any other consideration in respective of the use of that application. Okay, right? Whether use it entirely for promoting the activities of the organization, government said that you will not be eligible for tax exemption. Okay, right? And what it says is that when your activity, aggregate receipt from that activity, main income earning activity, when it exceeds 20% of the total receipts of the trust. I'm sorry, I'm going a little faster because I'm trying to become conscious of the time. Supposing your aggregate income of the organization is 100. Okay, I'm sorry. And from this activity, supposed to be business activity, your income is 25, which means that you have exceeded this 20%. Then the entire trust activity was not eligible for tax exemption. The law as it stands now, because your income exceeded from this activity in the nature of trade or business or commerce or any services or any activity rendering services to trade or business or commerce, you are exceeded 20%. So the exemption as it stands now says that you're not eligible for any tax exemption. To help organizations, such organizations that violate section 215, government now says that if you are hit by this 215, then you can go under this new computation procedure under section 1310. Okay, right? So what it says is that if you are hit by this, you can take. So these are the four categories. Number one, you not obtain tax audit report for whatever reason is that. May no need to, the entire organization will suffer tax on the MMR, or you could not file returns in time, or you're not keeping books of account, or finally, you are hit by section 215. See this 215, if you are carrying out an activity on education, there is no issue at all because education anyway you will have to collect fees. So anyway you have to collect fees. If you are having educational activity, then there is no issue. Okay, right? There is no issue if you are having education. If you are doing yoga for which you are collecting fees, there is no issue. You are still charitable in nature. You are having hospital, you can collect fees. For preservation of environment or monuments, you can still collect fees and then carry out activities. Only when it comes to public utility, any other object of public utility, you're not allowed to collect fees, or you should not support any other organization, involved in business, trade, or commerce. Okay, right? In which case, what the law says is that the computation will be different now. Instead of losing the entire income, now what it says is that income tax shall be income shall be computed as follows. After allowing all objects of all expenditure for activities incurred in India, provided it is for the object of the trust. Whatever you are spending. Right now, what the department stand is that they were taxing under, I mean, they don't specify that, under income from any other business. And they say that these activities are not meant for earning income, or under the PGBP, profit and gains of business or profession, saying that these are not incurred for earning income. But now, specifically, the law says, the new section 1310 says that you are allowed to claim all expenditure in India for carrying out the objects of the trust or the organization, other than capital expenditure. And you can claim depreciation also, provided you not claim depreciation, sorry, you not claim the entire asset as application the previous year. Supposing in this year you purchased a computer, yes, you can claim depreciation of the computer, but you will not be eligible for capital expenses. What is the law in case you're filing returns in time? In case you're filing your tax audit report in time, in case you're keeping books of account, or in case you're not violated 215, you're not carrying on any business activity. Okay, right? What is the law now? You can claim as application whatever expenses you're incurring for meeting out your objects of the organization, and also all assets that you are purchasing to meet out the objects of the organization. But if you are violating that, assets will not be allowed. Depreciation on that you can claim as deduction. Not only that, in case you are spending from the corpus, that will not be allowed. If you are not spending from corpus, that will not be allowed as main application. If you are spending from loan, that again will not be allowed. Okay, right? And again, you cannot make donation to the organization and claim that as a deduction. Regular organization, 12AB registered organization or 1023C organization are allowed to claim even contribution to other organization. But now if you are violating, you are not eligible for that. You can claim entire expenses other than capital expenses. And on that capital expenses, you can claim depreciation. If you spend anything on a loan, you are not eligible for that. I just put an illustration here. Supposing your income is 10 lakh rupees and your project is expenses are 6 lakh rupees. Your admin expenses is 1 lakh. Contribution other trust is 1 lakh. You bought computer 50,000 rupees. Your closing balance is 1,50,000 this, and you trust, I'm presuming that. And in such case, what will happen is 10 lakhs. Out of the 10 lakhs, you can claim 6 plus some 1, 7 lakhs as expenditure. So the balance 3 lakhs will be subject to income tax. Okay, right? I presume because they have not specified, under which section it will go. I presume it will be under section 164, it will be under the MMR, maximum marginal rate will be charged. And you can claim depreciation on this 5 lakh rupees. Yeah, on this 50,000 rupees. So 7 lakhs plus depreciation of 50,000 rupees. Balance amount will be paying taxes. So I hope this is clear. Okay, right? This I have already explained that to you. If there are any queries on this, you can put down in that. Next one, I am not going to explain in detail because lots of amendments on 1023C. I'll be sharing the chart with you. I'll just briefly explain what is that, what do I mean by bringing consistency in the provision. Two tax regimes, exemption regimes, what is that? Right now, income tax exemptions are available under section 1023C and under section 11 to 13. See, earlier, I think up to 2002, when we talked about section 10 exemption, we used to call this as a blanket exemption. If you are an organization, under section 10, whether you are an education institution or a medical institution, charitable, religious or religious and charitable, whatever way it is, if you are registered, if you are eligible under section 10, either automatically not required to registration or even registered one, okay, There was no conditions. It was blanket till 2002. No need for file tax return, no need to go under, 11.5 investment, no need to, apply 85%. It was blanket. But gradually, government brought in one condition after another condition. That is why if you see section 1023C, it has so many provisions, provided further, provided furthermore, provided that, so many provisions attached to that to make it consistent with section 11 to 13. So, these provisions, I told you there are exempted categories where there is no registration required. So these are the ones where registrations is not required. Broadly, there are two categories. One is education institution, and next one is medical institution. Essentially, the conditions are both should be for educational or medical purposes, not for the purpose of profit. Either they should be wholly or substantially financed by the government, or the gross receipts should be less than 5 crore. Okay, gross annual receipt should be less than 5 crore. If that is the case, you are not required to register under the income tax law with the commissioner or principal commissioner of income tax, but you're eligible for exemption under section 1023C. Okay, but other category will have to go through a registration, will have to follow all these things, but they were not consistent with all those provisions. Okay, other categories are given here. In fact, I put a chart because of time limit constraint. I'm not going to explain that. In fact, give an explanation to this will be very monotonous, boring to you. I'll share that with you. And I know that not many of you are having exemption under section 1023C, and you may not be interested in listening to this. And those of you who are having exemption 1023C, if you have any specific question, please write to me personally or WhatsApp to me personally, to me or to my team. We will be happy to clarify those to you. And with this, I'm coming to the end of my presentation. And I will give you a few more minutes before I open up for answers, question and answers. Okay. I want to recognize and acknowledge the presence of CA Sabujon and CA Ganga Christus, chartered accountants here. I'm not sure whether there are any other chartered accountants here. I want to thank you. Thank you so much for taking time off. I don't know whether CA Silas is also here. If they are there, I thank you for patiently listening to me. I hope these sessions are useful to you. To every one of you, I want to thank each one, every one of you for attending. In fact, consistently, I'm seeing about 90 of you, listening to you, to me. This is not a very interesting session. Income tax, I really appreciate you for the patience, for listening to me attentively, listening and trying to take notes. I will share this presentation little later because I'm planning to do, as I've been putting the groups, the similar program with Christian Insurance Management. So after that, I'll share the presentation. And those of you who want it urgently, if you communicate to me, I'll share the presentation. We have recorded this in YouTube also. Of course, the beginning part will not be available in the YouTube. Even that recording I will share only later, not now. Okay, right? I leave the floor for you. Please have your questions and put it in the chat box, because if you start talking to me, then it will be chaos because everyone will be talking and will not be able to hear. Put it in the chat box. Our team is collating all the questions. Then we'll reply. And finally, Sutesh will say that thanks to you. Thanks to you. Thank you so much. Thank you, friends. Thank you. I'm closing my screen share so that you can do that.
Thank you, sir. The session was really informative and you made it very clear. Thank you so much, sir.
Keep your mic closed. Keep your mic closed because I'm not able to hear clearly. Yeah.
Yes, sir. Thank you so much, sir. You made it very clear and the session was really informative. So thank you so much for that. So now I'll share the questions so that sir can answer it now.
There are requests saying that they want to meet me in person. Yes, I'm available. I mean, in fact, our tax filing season is over now. So, which means that I'm available. Next week, couple of days, I'm going to a client's place. After that, yes, and I've also agreed to meet clients. I'm available to meet. But please, make sure that we agree on the date and time so that we will meet at that particular time. COVID is still not completely over, so we are trying to be careful. We have noticed that still now, officially, we have not communicated our address. We plan to communicate only now. The main reason is even still we are working from home. Some of our team members, like for example, Jency, she sits at home, and Esther, she's not visible, she sits at home. Mr. Kanyapan, he's working from home. And we keep only about 6 people in our office at a time. We don't want to have crowd here. So till we are safe, in fact, I want you to be safe. So we will be careful. So I am definitely available to meet you. I'm coming to office every day, except the days when I go to my client's place. So I will be definitely available to meet you. Let me know when you want to meet me, then we will reorganize accordingly. In fact, I've already agreed to one of our clients from Velu that I'll meet them next week. Okay, thank you so much. I'll take the questions one after another. Dr. Sam Siddharth, what does application of income mean? Application means, since unlike the business clients, when we talk about charitable organization that has exemption under section 12AB or 1023C, whatever you spend for the purpose of your organization towards the objects of the organization, it is allowed as application. Normally, when we spend money for business people, as I've explained to you with reference to section 1013 subsection 10, it is only the revenue expenses allowed as application. Revenue expenses allowed as deduction. For example, we run a chartered account office. I'll take our example. We pay rent for running this office, so that is allowed. We pay electricity, allowed as application. Salaries, allowed as application. I buy computers for my office, that is not allowed. I get only depreciation on my computer as deduction. Whereas for charitable and religious organization or charitable or religious organization, even the computers, assets that you buy are allowed as application. You make contribution to other organization with similar objective. They have 12A registration, 12AB now. That is allowed as application. You have taken loan in earlier years because you do not have enough income to meet the activities of the organization. This year you're repaying loan. Even that repayment of loan is allowed as application. So application for charitable organization covers a whole lot of things. I mean, there are decisions which say that income tax that we pay is allowed as application. It is not allowed for anybody else. Okay, so application is a wider term. In simple terms, if I want to say, whatever amount you are spending, irrespective whether it is capital expenses or revenue expenses, towards meeting your objects of your organization, it is allowed as application to you. Okay, I hope I made myself clear, Dr. Sam. Brother Rajesh, 26 years interest certificate still applicable? Yes, brother. It is still relevant, and we compare that with AIS, annual information statement, because annual information statement gives more information. Okay, in fact, Ms. Grace Lynn will be able to explain, Ms. Manaka, Ms. Anandi, Ms. Monisha, they'll be able to help you much better because they are the one who actually did the feeding of the forms. So they have done analysis of annual information statement is There are some income which are not available in AS, but are available in AIS, annual information statement. Okay, so you can, it is still relevant for us, it's still applicable to us. Okay, right. But there is no need to thank me. I mean, it is part of my responsibility. Thank you. Mrs. Usha Krishnan. Ma'am, Usha Krishnan, ma'am, this is a challenge. It's a challenge when we have Section 8 company, we are bound to follow accrual basis. So when we are reporting the FCRA, we have to report on the cash basis. From now onwards, when you're reporting income tax, we have to follow cash basis. Particularly for expenses, we have to follow cash basis, and that we should have, follow that. It's going to be challenged. It's going to be challenged, and it's a challenge not only for you, the clients. It's for us also, right? When we are auditing your accounts, we face the challenge. Our team will face the challenge. We'll have to make sure that we are accounting in expenses on account of cash basis. Whether Deva Prasanam is the same account or have to open separate account. Do you mean to talk about different activities, brother? If you're talking about different activities, if you have a good accounting system, one account should be sufficient. But if you are not happy, see, there are donors who insist that, means especially if you are getting grants from them, they insist that you should keep separate account for each activity. Their funds, in which case you should have a separate bank account. Otherwise, if you have a good accounting practices, one book of account with clear ledger heads, earmarking for activity, it's sufficient. In fact, those of us who are familiar with accounting standards, we have what is known as segment accounting, segment reporting. So slowly we are moving into that area for non-government organization also. The Sudhakar, if 85% is income, what will be the tax? I have explained to you, brother. There are various options available to us. One is setting up under section 11.2, or if we're applying in the next year, supposing the grant received to the fag end of the year meant for the next year, we can go under the explanation 2.2 section 11.1. We can use one of that and then do not go under that. If you're still not able to comply with all these things, then unfortunately you will have to pay taxes under section 115 BBI. Okay. Brother Lakbir Wasi. Income received by donation during this year. No, brother, I've explained to you very clearly what is corpus donation. Corpus donation, you'll have to get from your donor a specific direction that it is towards corpus. It should be a written letter. You cannot presume. For example, you cannot have a dump box. I'm sure you're aware what is dump box. You would have seen in hotels or important places a box, but donations are collected. It says the organization name. When you cannot put that offerings in the dump boxes towards corpus, that is not happening. Or if you're running a church, you cannot print the cover and say that this cover is for corpus donation, unless the donor specifically signs that cover and say that this is towards corpus. Only then it becomes corpus. Otherwise, donations by nature will not become corpus, except in case of section many organization that are notified under section 80G subsection 2. I don't remember the clause by the central government. Only they can earmark donation for their general donation as corpus. Okay. Brother Philip, does influence business include publicity products? I need a little more clarity, brother, if you are involved in environment. Okay, right. What do you mean by environment? Do you mean the what is that? Natural farming, things like that? Is it part of your organization objective?
No. I mean things like you for publicity you make T-shirts or and then you sell them, those kind of things, or you are making stuff like that. And also the second part where you have books, let's say we are doing environment, books on environment, production, resale. It's almost like a publication trust functioning, but you call it under the, it is part of our publicity. So because we are, we are promoting environment. So all these things are required. Even some of the products we are making, we are reselling them because we are promoting environment. That is the main thing. Can we get away with that?
Whether you have to first look into the objects, whether these activities, because publicity will come as an administration activity. It is not your main activity. Okay, right? It is not incidental to your business also, your main activity also. So you have to first check whether the objective covers that. Okay, if your objective covers that, then yes, you can go to that. The selling of T-shirts and things like that could be a little difficult. Okay, right? But if you are a religious organization, if you have Bible verses, or if you say that it is towards promoting the religious activity, then yes, because section 215, restrictions does not apply to religious activities. Okay. Whether if you're not clear, then I will spend time with you later.
Yeah.
Okay.
Okay.
Now, Dr. Sam Siddharth. Doctor, it much depends on what type of activity you're doing. See, for religious organizations, because your organization is a religious one, I will not name that, okay, right? Because there are others also there. For religious organization, these registration fees, there is another problem also when we take registration fees for online courses. Online courses will be, can be a business, but it is, if you're, for example, you're conducting something connected with your organization objective, then it is incidental to your organization activity. Then it is a business, and you keep separate books of account, then you need not worry about it. Okay, right? If I'm not clear enough, Brother Dr. Sam, I'll explain to you a little later. Okay, right?
Sure. Thank you.
Brother Stanley Chalapa, what you're doing is right. Absolutely right, because you're keeping this in fixed deposit. See, when you created this corpus, that particular year, this restriction was not there, because this was come, I think, my memory is right, 2021 only. This has come, not even 2020 amendment. So what you're doing is right. So now onwards, please continue with what you're doing. The moment when you liquidate deposit, even though it was created earlier to the amendment, it will be treated as, not as a cost, it will be treated as an income, and then you have to apply that in that year. Okay. New Let's Worship Center, just change the trustees by supplementing. This may not be necessary, Pastor, for changing a supplementary, provided, your original deed itself says that you can change, because they are not changing any rules and regulation. Within the rules and regulation, you are following that. Supposing you are changing, making a basic change in the structure of the trustees itself. For example, you have now only 3 trustees as per the trust deed, and it is not given. There is no provision to add more trustees. Within the 3 trustees, you can rotate. Supposing you want to change that into 5 trustees, and you want to make out of the 5, 2 as permanent and 3 as rotational, then it changes the rules and regulation. In such case, it is better that we go to the commissioner and take his approval. Does ESA membership compulsory even for MUT is going complete? No, brother, it is, in fact, ESA is compulsory even for hospitals also. Okay, right. So I was helping Madras Diocese. Many of you know in what capacity I was helping. So Madras Diocese has 3 major hospitals and 3 other small hospitals. Of course, 3 major hospitals, big ones. And we applied to ESA hospital for exemption. We could not get, hospitals could not get. To my knowledge, only CMC Vellore has got exemption from ESI. Okay, others are not. So, and such is the case for hospitals. I don't think MUT can ask for exemption. So, reimbursement of hospitals' bills will not be sufficient. If you have 20 or more employees, these employees will include even contract employees, then you should go for ESI and PF registration. Bible International. So this is a prior approval of amendment of objective is there for quite some time, brother, because this was introduced as a condition for registration under section 12WA quite some time back. And when they introduced tax on accredited income, this was already brought in. Section 115 TD to TF, this was brought in. Now they are bringing in as a clarification in the conditions to exemption, because all of you have got section, the form 10AC for approval. If you go through this 10AC, it is already there in your form. So it is there. So this condition is already there. So at least from now onwards, you have to be careful. To register professional tax is a big motor of taxation. Cynthia will try to help you because we also need to go through for our own office now, because now we are crossing this 20 limit. So once when we get it done for us, we'll help you for you. Okay, right? Simultaneously, we will go to that. Bible trans, sorry, is minimum amount of donation. See, brother, there is no minimum amount of donation to receive in cash. Only if you have tax, ATC exemption, there is a limit. If there is less than that in cash, then the donor will not get any benefit. But mind you, there is another section, section 269T, if my memory is right. If any transaction above 2 lakhs takes place, then the person who is entering to the transaction will not pay a penalty. For example, you get donation above 2 lakhs in cash, then you will be paying penalty equal amount of 2 lakhs. And getting cash donation, small amount is okay. And anonymous donation is also there, made in income tax law. What it says that if you receive in cash, where the donor's identity is not known. The moment when you say you receive in cash, the question comes that whether it is anonymous, because you can always put some names or addresses, give some information, because receipt after all you are making it. The partner will have a doubt. And when they invoke this anonymous donation provision for receipt in cash, you will be liable to pay tax at 30%. So it is better to avoid donation in cash. There are clear exempted organization. One is churches, religious organization. You cannot insist in the church people to come bring donation, offerings and check and deposit. Or only boxes you cannot say you put it in box checks. So government understand that if you are a church, religious organization, you are exempt. But at the same church, if it is running, the same church is running a hospital or a school or a home, for that you should collect only by check. You cannot collect it in cash. Okay, right? So I think I've answered your question also, ma'am. Mr. Srinivasan, I don't have time to explain that. Maybe another time we will look into that. Benefit to the trustees, because section 32 lists that. What I will try to do is that I try to send when I'm sending the PPT. I need some more time to send the PPT. I will add that the benefits on the section 32 and send that to you. Okay.
Okay, sir. Thank you, sir.
Welcome. And the Joshua admin, you're at liberty to accumulate 15% or less than that year after year and keep that accumulated amount and make that as an amount. The idea is that, in fact, earlier it was 25% allowed to accumulate, because we are not a business where we can make money. Provided subject to economic conditions. Otherwise, you can earn particular income. Because we are a charitable organization dependent mostly on voluntary contribution. The word voluntary makes it very clear. You may get 1 year, may not get another year. Even donors, they may give, because again, that's voluntary. They may give 1 year, they will not give another year. So government when understands our difficulties, that is where they allow the 15%. So it means that year on year, you can keep on accumulating this money, 15%. And then when there is a need, you can utilize from this 15% for the need for the subsequent years. But you cannot claim that as an application in subsequent year because that is not the income of that year. You are allowed to accumulate for any number of years. Sir, Arunachal, sir, I think I've already answered your queries there because when you receive donation in cash from a donor, this anonymous donation section will get hit and then run into a problem. So it's better that you get donation in cash. When you're getting, please make it mandatory that you should have PAN and also avoid as far as possible getting donations in cash. I think with this, I'll wind up my main presentation and my session. Once again, thank you so much for the time that you have taken. And in case there is anything left pending, we have created a group. Please post your queries in your group and we'll be happy to answer all your queries. Okay, thank you so much. Over to Jency.
Okay, thank you, sir. So without any further delay, it's due to lack of time, I call upon Mr. Sutesh Sadanandam, Chartered Accountant, one of the partners of John and Julian Chartered Accountants, to deliver the thank you note. Thank you.
Thank you, is a partner in John and Julian, and Mr. C.S. Arunachal is also partner in John and Julian. Over to Sutesh. Thank you.
Good afternoon, one and all who have taken time to participate in this seminar. This is CA Sudesh Sadanandam, partner, John and Julian. It's my privilege and honor to deliver the word of thanks speech. First and foremost, I thank God, our Father, for having given this kind of opportunities to learn new things so that we can be law-abiding citizens. Secondly, I thank the speaker of the day, our beloved brother, C. John Ravindran Moses, for his passion on the subject and presented this webinar in a lucid manner. Thirdly, I extend my sincere gratitude to all the tech savies who have worked behind the screen for the success of this webinar. I think without them, we will not be able to see and listen one another's speech like this. Thank you, Jency, Monisha, Menaka, Priscilla ma'am, Kamachi ma'am, and all others who have really contributed their efforts and time for this webinar. Fourthly, and lastly, I'm delighted to thank all the participants. I think 90 plus participants have attended, who have taken time, efforts to learn the proposed amendments. So God bless you all. Have a good lunch after this food for thought. Over to co-host Jency.
Jency, just a small thing. Jekran, are you available here, Pastor Jekran? If he is available,
yes,
can
yes,
you
Anna.
Pastor Jekran to close the meeting with prayer? Before the Jency's closing remarks, if there is anything. Jency, any closing remark, or shall we ask Pastor Jekran to close the meeting with prayer?
Yes, sir, we can ask Pastor to close the prayer.
Yeah, let us pray. Our Father in heaven, we are so grateful today for this opportunity you have given us to come in this manner and to be given this understanding of all these changes that have taken place. We want to especially thank you for our dear brother John Ravindran for his heart to serve your people and the purposes of your kingdom. We thank you for the many decades he has invested so willingly and cheerfully in each of our lives, in the organizations and the churches that you have given him to steward. And we want to bless him in your name. We pray for every blessing in Christ to rest upon him and Akka and their daughter, and also upon their entire staff and the partners. And we want to pray, Lord, that you will continue to bless them to be a blessing for the purposes of your kingdom. We want to thank you and all that we have learned today. We pray that you will help each one of us to apply it in our context. You will give us the wisdom so that as we comply with all the requirements, it will bring glory to your name. We thank you. We bless you in Jesus' name. We pray. Amen.
Amen.
Thank you, Ravi. It was a wonderful presentation.
Oh, thank